COVID-19, the global economy is at a standstill. Markets are in turmoil.
The S&P 500 opening lower by more than 8%. Of course, that greater than the 7% level that triggers the level 1 circuit breaker.
Retail sales down.
Oh my God, look at this. All right, retail sales year to date minus 20%.
Unemployment up.
4.4 million people filing for initial jobless claims last week.
Even if ultimately temporary, it will have a significant impact on economic activity.
Some economies are opening up.
To preserve the health of our citizens, we must also preserve the health and functioning of our economy.
Despite warnings, opening up too early could have consequences.
Ultimately, the virus is going to determine when we really can safely reopen.
In this time of crisis, how can investors navigate volatility and uncertainty? We convene the biggest names across finance, economics, and investing to help investors weather the turbulence. We are live in Hong Kong, Dubai, London, and New York for exclusive interviews and smart analysis. This is Bloomberg Invest Global.
And good afternoon, everyone. Welcome. I'm Yvonne Mann, a co-anchor of Bloomberg Markets Asia here in Hong Kong. Thank you so much for everyone for joining us. This is, of course, our day one of our Invest Global's special virtual series. And we're glad you can join us here, of course, on a virtual setting. Of course, I would love to be with you guys face to face, but this is just the new normal that we're dealt with now. But hopefully we can have a very engaging afternoon as well. Over the next 3 days and across all regions, from Asia to Middle East to Africa to Europe to the United States, we're going to be speaking to some of the most influential voices in finance, economics, and investment today, all to make sense of the extreme volatility we've seen in these global markets, as you saw with that dramatic introduction video. Where are we now? What are going to be the near-term, long-term consequences of this virus as economies emerge from this unprecedented time, and of course these lockdowns as we see more of these cities come out and reopen. So we have a lot to take care of course. Let's kick it off now with thanking our sponsors. We couldn't have this event without them, starting off with our U.S. founding sponsor, Invesco QQQ, our European sponsor, CMC Markets, and EcoBank, our Middle East and Africa sponsor. Thank you all for the three for your help, of course. And if you want any more information on our sponsors here today, you can check that out in our resources section as well. Before we begin, we do have some housekeeping rules that just to keep in mind. If you want to view these sessions, make sure you're using Firefox or Chrome. If you're having trouble with audio or video quality as well, please refresh your browser as much as you can. Also, if you want to restore the windows, you can also adjust some of the screens and the size as well. That's all happening, the buttons at the bottom of your screen if you're looking down there right now. And also the size of the windows can be adjusted as well. So this is going to be an interactive event. Of course, as I mentioned, we want your questions. We want you to engage with us during this time. So if you want to submit a question, you can see it underneath the slide section, the Q&A box there. That's where you submit your questions. Make sure to click submit and make sure to include your first name and the city when you're asking a question as well. We're also going to be taking live poll questions during this time. So feel free to take part in those as well. We want to get, of course, what everyone's perspective has been and some of the big questions we've been asking in the last couple of weeks. So that question is going to pop up on the right side of your screen there as we're talking. So please take a moment to put your responses in. We want to hear from you as well. On social media, you want to engage with us, feel free to check out Twitter. Our hashtag is Bloomberg Invest. Also, of course, you can track all the updates on LinkedIn as well. So let's kick it off with a Q&A right now, a polling question, shall we? Today, of course, a lot of news over the weekend when it comes to Hong Kong. So this is the perfect setup for our first guest as well. This is what we're asking. Do you think Hong Kong will remain a financial hub? A, click yes if you're saying A, Hong Kong will survive the stress test. B, no, Singapore will take over. And C, answer is wait and see. So let's give a couple minutes for these results to come in. So far, we do have no, Singapore will take over. So about 47% of you have submitted your results so far. So Yeah. 38% say yes, Hong Kong will survive this stress test. About 14% are saying we will wait and see. So at this point, it seems like most people are having a little bit more of a pessimistic view on what's next for Hong Kong. Perfect time to really bring in our next guest. I want to bring in Charles Lee, the CEO of Hong Kong Exchange. Just want to give a brief intro of Charles. He served as chief executive of Hong Kong Exchange and Clearing Limited since 2010. In this role, he's been pivotal in making some very strategic initiatives for the Hong Kong Exchange and its history, including the acquisition of the London Metal Exchange in 2012, OTC Clear in 2013. You have Shanghai Hong Kong Stock Connect. You have Shenzhen Hong Kong Stock Connect. You have the Bond Connect that happened about 3 years ago. He's also sought to strengthen Hong Kong's role as an offshore renminbi hub. He's also led Hong Kong Exchange's efforts to reform its listing regime to maintain Hong Kong's competitiveness and secure its position as the leading IPO center. They're hoping to be number one again this year. Charles, welcome to Invest Global.
It's great to be here, Ivana. Wonderful time to join you, having all these great discussions.
Yes, and let's kick it off. I mean, Hong Kong Exchange just coming off of what's been a couple weeks of very strong debuts on these secondary listings, these Chinese tech companies coming back home, starting with Alibaba, we had NetEase, and then JD.com last week. Your chairman, Laura Cha, told us just last week she hopes 2020 is going to be a better year than last year. What's your take?
Well, this is going to be a big year no matter what. I think it's not only about all the companies coming from US and other market back to Hong Kong, we're also going to have a lot of big homegrown IPOs coming up this year. So I'm not sure whether this year we're going to be number one again, but it's looking that we will definitely be very strong, and it's going to be very competitive. It's a great market. The underlying market is very strong, very resilient, despite all the challenges we're facing today.
But right now, you take a look at these Chinese tech giants and mainland investors, they still can't get their hands on these shares in Hong Kong. What's the chance that that scope of expanding the southbound Stock Connect and expanding that to include some of these companies?
Well, it's not a matter of whether they will be included. It's really going to be a matter as to when they will be included. At this point, all the the Hong Kong side of the issues are very much resolved, and I think we're working with our partners in the north to ensure that their issues being addressed largely, that they want to see some hope that some of those great companies one day will consider a domestic listing. And I think that's one of the reasons, one of the issues that we working with them. But ultimately, even everybody agreed that having a lot of the customers of many of these great companies to become their shareholder is the common interest of all parties involved.
What sort of timing can you tell us on that? Is this a priority to you to get some of these stocks included on the Stock Connect, especially that some of these companies might be included in the Hang Seng pretty soon too?
Yeah, I think that there are things that we can do here in Hong Kong, including some of the changes in the system and the rules that will allow them to be potentially designated slightly different from its current form. But that may or may not necessarily be sufficient for us to reach agreement with our friends in Beijing and Shanghai and Shenzhen. But I'm sure this is something that is in the horizon. And I don't want to give you a specific time, but it's coming.
It's coming. Okay. Do you think it runs against Beijing's own ambitions then of reforming its own stock boards? We just learned last week that the CSRC is going to speed up the process to include the Shanghai Star Board stocks onto the Stock Connect. How does that change the attraction, I guess, of Hong Kong and the appeal versus Shanghai when some of these high growth companies choose where to list?
It's highly consistent with the broader policy goals of China and policy goals of the regulator, and also consistent with even the commercial interests or competitive interests of the exchanges. It just sometimes, with the COVID, with everything, We just need a bit more patience. We got everything done, everything we ever wanted to get done. Ultimately, most of them got done, and I'm very confident that this will get done.
Do you see China's reforms affecting Hong Kong's IPO outlook in a longer term perspective, if especially we continue to see political unrest here in the city?
No, I think one thing people sometimes do not fully appreciate that the market are really mutually reinforcing and mutually helping each other. So the more open China is, the more opportunities we actually have. Obviously, when they're more open, you have slightly different opportunities when they are more closed. So it's not about a binary thing that if they're more open, then people are not coming here. And we are very differentiated in our roles, in our functions, and in our mutual complementary strength. So as long as we remain agile, we remain resilient, and we remain relevant, we will always be able to solve the problems that they couldn't solve at a particular time. And when they are able to solve those problems, we're going to move on to solve other problems that they are. As long as China continue to open, and as long as that we are able to remain on a competitive distance and a differentiation, we will always succeed together.
But investor confidence, no doubt, it has been eroded in some ways with this national security legislation. I bring it back to the poll survey that we just conducted with people that are viewing this conversation right now, Charles. And most it's pretty split right now. 38% say that Hong Kong will not remain a global financial hub. 37% say yes, Hong Kong will survive the stress test. We just got this draft bill of this national security legislation, and the central government has confirmed that they can actually trump the Hong Kong legal system when it comes to national security issues. How are you maintaining or reassuring investors right now that this is not going to be as big of a deal, or at least address the concerns that they have right now?
Well, there is going to be absolutely short-term anxieties and short-term, discomfort, because this is not something that people are used to before. And also, in light of all the massively geopolitically sensitive time that we live in, this will be, it's fully understandable. But I think if anybody who really understands Hong Kong, understands China's, overall traditional, philosophical approach, in Hong Kong, they should really, pretty easy conclude that ultimately the long-term impact is limited because, two systems, one country, two systems, absolutely works for the best interest of China. And I think no matter what happens, no matter what the U.S. Government will do, in terms of its conflict with China, and I think ultimately, and even with the national security law introduction, Hong Kong will remain to be the most international, the most open, the most free, the most Western market of China. So maybe slightly today, we used to be, people used to know us as the most Chinese, kind of an international market. Maybe tomorrow we will still be the most international and most Chinese market. But I think in order for people to have a better comfort on this very emotional issue, I think it's important to quickly have a few words about, why we are here, and also how this is going to be implemented and how people are thinking about it. I think we are here on a very, very simple issue. I mean, it's one country, two systems sounds like a very complex issue. But in fact, if you look at China, is very emotionally about one country, but is very rationally, accepting that two systems in Hong Kong is the best for China. And on the converse side, we people in Hong Kong are very emotionally invested in two systems because we want our freedom to be preserved, our market structure to be preserved, our common law, rule of law to be preserved. So we're very emotionally invested in two systems. All we need is that we rationally also embracing or accepting or at least not oppose one country. So our interests are very much matched. China emotionally about one country, but rationally wants this to be two systems. And we want it to be emotionally and to be two systems. All we need is to really make sure we don't challenge two systems and not challenge one country. Back on this national security law, and I think we're all been debating over the last couple of weeks about whether or not this is going to be done through a Hong Kong system, and in its original common law framework, or it's going to be imposed from China. I think it's becoming quite clear today. I mean, basically what we really wanted, and since we have to introduce a tiger, the China want to make sure this is not a toothless tiger that is not going to be able to bite when it's need to bite. But obviously, people in Hong Kong want to make sure that this tiger only bites when it should and doesn't really bite all the time. So how to remain the most delicate balance is the key. And I think I was looking at the rules that just came out. It looks like it's going to be local tiger, but with some supervision.
Okay, we have a viewer question. Could be a good follow-up to what you just said here. William Barr, the U.S. Attorney General, did speak about intervention today. He wants U.S. companies to stand up for the U.S. and reduce business with China. Do you see this having a potential damage to China and Hong Kong?
Well, anytime a U.S. president or attorney general says something like that is not helpful. In fact, if they ever wanted Hong Kong to succeed in its original terms, this is not something terribly helpful. I know maybe they have a particular, geopolitical and ideological angle to it, but in the end, Hong Kong, as I said, is just going to continue to thrive simply because China wanted it to be two systems, as long as that one country sensitivity and emotional needs is being addressed. And with this security law, hopefully.
I was going to say, U.S. government, though, has been scrutinizing these Chinese companies that are listed in the U.S. They're threatening to delist them. Hong Kong's special trading status could be under a lot of uncertainty right now. How does Hong Kong Exchange view this right now? Net, is this actually a win or lose situation for Hong Kong Exchange? What can be done?
Yeah. I don't think the U.S. Regulations or proposed legislations on the Chinese listing companies are all about their being Chinese. At least that's not what they said. I hope they don't do that, because that's not what I read in those legislations. It's all about accounting standards, about regulatory compliances. So in that regard, we're all having exactly the same common interest. We don't want substandard companies to be listed in any market. We don't want them to be here if they are not able to qualify in the United States, or if they are delisted because of those reasons. I don't think the American government will actually delist all this just simply because they're Chinese. So from that perspective, all good companies, they will come back, not because they are going to be deterred by the American legislation, but obviously the less friendly environment and sentiment in the US is now helping them having a lot of confidence. But we're here, good companies can come back, bad companies don't qualify anyway. And when they do come back, if they feel that this is a better place for them, more trading will happen here. So at this point, we are seeing tremendous interest, both in terms of issuers wanting to have another secondary listing. Some may eventually wants to move to primary listing. We all welcome, but at the same time, if people want to go to America, we still think they should, because there are things in America that is unique, and some of those companies find their unique match with the investors there.
Charles, we have to go in a couple minutes, but we have one more viewer question. Are there more Luckin coffees out there waiting to be discovered? And if we do see these companies and these audit questions remain, is that going to temper the IPO exuberance we've seen here?
Yeah, we're going to see bad apples all the time, and they are existing here, China, US, Europe, and everywhere. And the key is to make sure the bad apple don't succeed. The bad apple don't really fool the regulator. In fact, in many ways, the bad apples are finding it's much harder to fool raw regulator here than in the US, simply because the distance, because of the lack of familiarity it's much easier to handle a bad story in a Florida retirement community than they can do in Hong Kong. We see through them right away. So they're not coming here because they know they're going to be seen through very quickly here.
Charles, we know that your time at Hong Kong Exchange ends next year in October. What tell us a little bit more about the legacy that you want to leave behind. What was your proudest moment at Hong Kong Exchange, and what are some things that you still want to accomplish before you leave?
Well, this is really the most interesting and most dynamically exciting 10 years of my career. And we just happen to be at a time when China is becoming so important to the world and the world is becoming so important to China. So the last 10 years, we're really just trying to break barriers. So there are really three major breakthroughs that I'm the most proud of. Essentially, breaking Hong Kong Exchange into commodities, into international. We used to be just equity, just Hong Kong, and now we're international. We are, FICC. Number one. Number two, breakthrough into China's capital control barrier. We know China will maintain capital control for a long time in the future, but how to find a way to allow that capital control to exist, to give China the confidence, but meanwhile allow the market to have a truly free back and forth. We achieved that Shanghai Connect, Shenzhen Connect, and Bond Connect. So connectivity is the second big thing. The last thing is we used to be largely an old economy, banks and property company listing, venue with very little diversification, particularly very little DNA for new economy and new technology. The listing reform is a massive breakthrough. Today, we are able to compete on new economy, new technology, biotech with anybody on the world. And I think we will become, I'm a big soccer, a crazy soccer guy. We will go into the World Cup finals. I'm confident of that.
Okay, real quick though, anything else that you still want to do before you leave?
Well, I just think what we wanted to people to truly understand that a lot of those challenges, particularly in Hong Kong, with the emotional charged debate about one country, two systems, we sometimes lose sight of the fact that the system as it is today absolutely works for everybody. There's no reason for China to change fundamentally, and there's no reason that people in Hong Kong wanted to change, radically. But sometimes, we just need to be thinking emotionally what's the other side care and what rationally they need, and we match that. And we don't have to, again, get ourselves caught up in a moment where we could have easily rationally accepted something so that we can preserve what is important for us emotionally. And when you miss that, then you get yourself into a real hard place, between a rock and a hard place. And I think we're going to get out of this because, again, I'm still tremendously confident that China want one country, two system. They do not want to make Hong Kong into another Shenzhen or Shanghai. It's not in their fundamental interest. So I think, the survey, if we do the survey in 6 months, I'm sure the survey will be very different from what you're seeing on your screen right now.
Charles, we got to leave it there, but thank you so much for kicking off Invest Global with us. It was a great conversation, and I'm glad we got some of the viewer questions in as well. Everyone, thank you so much. Charles Lee, Hong Kong Exchange. Charles Lee, Hong Kong Exchange CEO there, joining us with the latest. And thank you so much once again. All right, I think it's time to do another polling question before we bring in our next guest. We had quite a bit of response here. This is the one about the economic recovery. What shape will the economic recovery take? So this is kind of the so-called alphabet soup type of game that we're going to play here. Is it a check, a tick mark shaped, Nike swoosh, as some say? I saw someone say, was it more like a square root shape, U-shaped, or V-shaped? The markets seem to think it's about a V-shaped recovery. Right now we're saying when it comes to the responses, 27% or so far say U-shaped, that perhaps this is going to look a little bit longer for things to really come out of the worst of it, 29% so far. So it seems like most of you guys think that this is going to be a nascent recovery at best, what we're seeing. Perhaps there's still ways to go before we get back, of course, to those pre-pandemic levels. All right, we'll wait for some of those more responses to come in. I want to bring in our next guest. He is known as the turnaround king. He knows a little bit of something when it comes to leading organizations away from change and from recovery and moving it to recovery. Ross McEwen became the group chief executive of and managing director of National Australia Bank. He in December of 2019. He has more than 3 decades of experience in the finance, insurance, and investment industries. And prior to joining NAB, Mr. McEwen was also group CEO of Royal Bank Scotland from 2013 to 2019, was also instrumental in reviving the fortunes of the bank after the global financial crisis. So I want to welcome Mr. Ross McEwen. Ross, thank you so much for joining us.
Thanks, Yvonne. Nice to be with you.
All right. So we kicked it off with, of course, what we've been seeing here, where people are still very unsure, uncertain about the economic recovery from this unprecedented health crisis that we're seeing right now. You were known as one of the biggest UK corporate turnarounds during your tenure at RBS during the financial crisis and really successfully turned it back into profit. What sort of lessons are you getting from then and you taken those days during the RBS days, and how are you applying it now to NAB?
Well, first off, I think the crisis that we had from 2007 through is quite different to the crisis we're experiencing here. This has come across, it's hit so many businesses so quickly because economies closed down effectively. People couldn't move, we couldn't travel, all the tourism stopped. So this happened so quickly, and I was talking to businesses on a Monday, and by the Thursday, they'd closed their doors. So I think this is quite different to the last crisis that the world had around the global financial crisis. But there are some lessons that you can learn out of both. Firstly, now's the time to look after the balance sheet of a bank. And whilst everybody's worrying about profit and loss, which is still important, I think the balance sheet is the thing that we should all be concentrating from a banking perspective. And that's why very early on in this crisis, I talked to the board about going for more capital and making sure we were in a very strong position leading into this crisis, coming through it for our customers, and there's also being very strong at the tail end of it as well, no matter what shape this crisis takes. So there's some lessons we can learn. I hold on to a very strong balance sheet. And second thing we can learn is support your customers. Be very careful, don't support customers that won't be able to pay back because it's not in their interest or our own, but stay in a very strong position. I think we certainly learned that out of the global financial crisis.
We already have some viewer questions, Ross, one of which is, do we need to reshape capitalism? That didn't happen back in 2008, and that gave rise to populism and all the associated problems now. What's your take?
Well, I think we need to, as a bank, we need to be thinking about our customers and first and forthright. That will be the success of the banks, but also the success of customers. We should only grow when our customers grow. And that's what we're forming this bank around. Actually, we're forming it around twin peaks of the areas that we'll concentrate on. Firstly, customers, and secondly, our colleagues. Making sure we have the very best of colleagues who are trained and developed well to look after customers. And those are the two things that we're concentrating very strongly on. And it's about how do you grow a community? Because it's when you're out of balance with the community's not growing, yet a bank is, it looks a bit strange. We should only grow when our communities and when our economy are growing. That's when a bank should grow as well. So it's keeping everything in perspective.
And Ross, NAB is notably Australia's biggest business lender. You probably are most exposed to some of these companies that have been hit hard by COVID, these SMEs. What are your clients? What is the bank data telling you at this point? How many businesses can actually survive coming out of this crisis?
Well, look, we made an assumption that those businesses that were strong going into this crisis, we should be there supporting them because we know nothing different. Yes, there'll be some sectors that we have to be much more careful with and we'll have to support in a different way. But our view was a good business going in, we'll support to be a good business coming out. But it may take some time. You're already seeing some industries doing quite well, but you're also seeing some industries, obviously the inbound tourism industry, the airlines, are really struggling. So you have to care for them in a different way to what you would for other businesses that may not be affected as much. But our going-in assumption was a good business starting is a good business that'll come out. But on the other hand, if you had a struggling business going into this crisis, it's very unlikely that it'll survive or do well going through it. So therefore, you need different strategies per business.
Obviously, there's been a lot of focus on the tensions between China and Australia, Ross. We have a viewer question as well saying that Australian politicians seem to be resetting the China relationship. How is that going to affect your bank clients?
Look, the China-Australian relationships are incredibly important for business. It's been a big source of income for Australia and obviously for China as well. And at the moment, there are these relationships are being tested. Our view is that over the long term, these relationships will build again. They've been very, very strong for decades. And the relationships are important to both countries, and they are being tested at the moment, but I'm sure that we'll be able to work our way through it. From a banking perspective, our ambition is to support our customers who are trading in China and vice versa. And that's been the biggest thing for us, is to focus on how do we make sure that these relationships enable us to do business, and also our businesses in Australia up in China still able to do business. We've got a business in China. It's important to us, but it's very much there for those people who are trading in China.
And even before this pandemic hit, Ross, the Australian banking sector seemed to have its fall from grace moment with this inquiry from the Royal Commission on financial misconduct. And how much of that legacy in this investigation is in the background when you're making these decisions on how to handle this crisis now?
Look, it was very important, and you're quite right. The Royal Commission showed that the banking industry, was not delivering in many, many areas that it should have been to its customer base and to the greater population of Australia. And it did need to rebuild the trust that had been lost throughout the findings of the Royal Commission. The crisis that we've gone into, the industry, I think, has worked very well with government, with regulators, with the Reserve Bank, and together, I think we've done a very good job to date of making sure Australia is in the best shape it possibly can be. And we did learn a lot out of that commission. There are some basic things that we just didn't get right, and we needed to admit to those and start fixing these things. But I think it has become a lot stronger. And you've seen the way that the banks have all worked together with the industry association and the regulators and the government to make sure that we're in the best shape that we possibly can, and putting the customers at the forefront of everything that we do.
Yeah, and you were just promoted to the CEO job, Ross, not too long ago, back in December. Between fighting the crisis right now and actually making real changes at the bank, how are you balancing your time now?
Well, it's quite an interesting situation to be in, that we'd started a strategic review back in December last year. And just as we were coming to the conclusion of that review, we ended up with this crisis on our hands. My view was keep going. We have very, very strong strategic positions both in Australia and in New Zealand with our businesses. The Prime leadership had left us with good businesses, and certainly in the business market and our corporate institutional in New Zealand. We've got a good but not great retail business that we can do things with. So actually strategically we're positioned very, very well. So our view was keep going, try and take some advantage out of this COVID crisis and how we think about the business going forward. And this crisis, I think, will create some opportunities. I think it's brought forward, and many of the trends that you may have thought may have taken 10 years are now on us right now. So, for example, in the last 14 weeks, the use of cash has dropped off dramatically. The use of cheques has dropped off dramatically. The use of ATMs has dropped off. These trends would have taken probably another 5 to 10 years to have emerged, and all of a sudden people don't want to touch cash. So the cash usage is down 25, 30%. So I think we're looking at saying, what could we accelerate? What are the parts of the strategy that we bring forward to in the next 12 months, not the next 36 months? And how can we shape the business to do a better job with customers using a lot more technology and our very good relationships that we have with our customers?
Obviously, we've seen a lot of aggressive action from central banks all around the world. Ross, a viewer question asking about the Fed. I mean, the Fed has said that it will do whatever it takes. What about the Bank of Australia? Where do you think interest rates are going?
Look, interest rates, I think, are low, and they're going to be low for a very long period of time. Our Reserve Bank has taken a very similar position, maybe voiced it in a different way, but there to be supportive. And it was right from the very start. And as I said earlier, the banks, the Reserve Bank, the regulators and the government, I think have worked very strongly together to create the best possible scenario that we all come out of this very well and look after customers and the community. And I think our Reserve Bank stepped in very early to make sure that there was liquidity in the system, and that has worked, and it has not been an issue. And I think my view is that they will continue to do so as they need. But it has also been all the parties working together. We've had a government that very quickly moved to support the economy through programs such as the JobKeeper program to try and keep people connected to their employers, so that when this COVID-19 starts to ease, people get back into employment. So there's been a lot of programs that have been put in place, both at a federal level and at a state level in Australia, that I think will stand the time and show to be the right things to do. But it's not over. There are many other programs that they may have to put in place.
Negative rates in Australia, could it ever happen, Ross?
Look, it could happen, but I don't see it. I'm not convinced that negative rates are where people should go. Having experienced that up in Europe where they got into negative rates, I'm not too sure how you get self out. So the first thing is don't go there. There are other mechanisms that can be used to help stimulate an economy. So, we've got very low rates here at 25 basis points. I'm not convinced that they need to go any lower than that. I'm not too sure what the benefit would be.
You mentioned about the JobKeeper program, of course, these wage subsidies to keep people attached to their employers, the stimulus programs we've seen from the government as well as the RBA. Is there a concern for you, Ross, that what happens when this huge government stimulus starts to get withdrawn?
Well, I think the government has, as I've said, done a very good job of stimulating to keep things moving along while we go through this crisis. I don't think governments can continue forever to do that, but I think there is a path that they can look after industries that have been very badly damaged that will take a lot longer. I would expect to see some of those industries with some form of support for a longer period of time. You've seen here in Australia, the government has started putting in place packages for buying for building of homes, to make sure that the construction industry, which is very essential here in Australia because of the need for more homes, that is kept stimulated and moved along as well. So I think there'll be smaller programs that will supplement as we go through this, and each one of them will have a very clear purpose. And it'll be ready to keep industries moving along until they can stand again on their own 2 feet.
And Ross, just bringing back the poll survey that we had with our guests here today, where 32% say that they expect this economic recovery to be more of a U-shaped. Some say 51% say it's W-shaped as well. So that's kind of where things are tilted at this point. The economy obviously is going to take some time to come back. There's also going to be pressures on banks as well. Are shareholders just going to have to get used to a less profitable future?
Well, I think in the short to medium term, it's quite clear that there will be a less profitable banking system here in Australia. But I say short to medium term because in the long term, it's a very strong economy here in Australia. We went into this situation actually in a very strong position from a government debt levels, and they've been able to support this economy. The banks were in very strong position from a capital and liquidity perspective. So there are a lot of very good things about the Australian economy leading into this crisis, and it'll emerge again. And I would suspect that people are looking at the performance of both Australia and New Zealand with some form of admiration. And I suspect there'll be a lot of people that would like to be living down this part of the world as things settle down. And Australia has always been very open for skilled migrants to come into this environment. It's kept the economy going. And I see a time when we get back into, say, 2022, this economy will be back again at GDP growth equal to or greater than where we finished 2019. What the recovery looks like, I'm not too sure whether it's a V, a U or a W. Today, having experienced a second wave of increases in the virus in Victoria, it feels more like a W. I think it's just uncertain.
And Ross, you did some bold moves here during your last earnings call or your earnings report. You talked about the recent capital raise. You did a dividend cut as well. Do you think NAB has enough capital to get through this crisis?
Look, on the scenarios that we've run, yes, we do. But our view was go for capital early, show the strength, make sure we've got capital to take our customers through the experience over the next 18 to 24 months. Make sure that we're in a very strong position coming out of this in, say, 18 to 24 months' time, so that we can take advantage of the opportunities and support our customers. That was the main aim of what we did. It was actually a very big day. We brought our results forward by 2 weeks. We did the strategic review on that same day, and we raised capital. But my view was be decisive, look after the balance sheet. It's going to see this bank through and always remain in a strong position. And I think that's something I certainly learned up in the UK with the experience I had with the Royal Bank of Scotland.
Ross, we're going to leave it there, but we appreciate your time and all your insights here today. Ross McEwen, NAB CEO, joining us there. Thank you so much. All right. So, of course, that was, again, a great conversation. We're going to segue a little bit now and talk to our own guys from Bloomberg Intelligence about kind of what's that story here for the next 5 years or so. What sort of trends are they seeing when it comes to the markets? We're going to be talking to our Gina Martin-Adams. She's Director of Equity Strategy and ESG Research, and Gaurav Patankar, Head of EM Equity Research and Strategy, just about what are the 5 key emerging market trends that they're looking out for. Let's take a listen.
Hi, I'm Gina Martin-Adams, Chief Equity Strategist for Bloomberg Intelligence.
Hi, I'm Gaurav Patankar, the Head of Emerging Market Equity Strategy at Bloomberg Intelligence.
We're going to jump right in and talk about the outlook for emerging market equities today. In particular, closing the gap with developed markets, 5 themes for 5 years. So, Gaurav, I don't think it's any surprise to anyone that emerging market equities have been a pretty big disappointment, secular disappointment, really, underperforming for the vast majority of the last 10 years, albeit a few fits and starts of outperformance along the way. I like to consider emerging market equities as something of a permanent valuation gap, lacking a catalyst, but you might see things a little bit differently. I'd love to sort of jump in and talk about this notion of 5 themes for 5 years. Will these 5 themes really change the landscape for emerging market investing? Is now the time to start to shift into emerging markets, or is it more a pick your spots carefully kind of story?
Gina, that's a great question and a very profound one too. So clearly we have been in the hot seat for the last close to a decade. I've been covering emerging markets for 15 years, and the last 10 years have been very different. Emerging markets, for the most part, say between 2003, post the Asian crisis, and say through 2014 or 15, were looked at as growth proxies, just as secular growth proxies, growing global trade, and the world flattening a little bit. But things have changed over the last 4 to 5 years. A lot of things have changed, especially as things change around global trade, post-COVID, and many other things. I think the approach to emerging markets would have to be nuanced. One has to understand that there are 26 different countries, each with their different macro trajectories, bottom-up fundamental factors, market setups, entrepreneurial class, and frankly, nationalistic priorities and geopolitical alignment. That's going to dictate where emerging markets go from here. That being said, we look at emerging markets almost with a split personality. At one end of the spectrum, we have a secular long-term scoring framework where we look at 46 factors and take a 5 to 10 year view of looking at emerging markets. At the complete opposite end of the spectrum, we really let the data dictate what's happening in emerging markets, and we have an emerging market scorecard where we take a 1 to 6 month view. Based on the confluence of both of these models, there are kind of 5 themes that broadly emerge. One of the themes, obviously, there are 2 axes to these themes. The first axis is emerging market governments. What are the governments thinking? What are they going to do? The second axis is the emerging markets consumer. So there are a couple themes that revolve around the government. The first is the renaissance of the emerging market industrial sector. And the second is exporters with a very large moat. The consumer themes they revolve around 3 broad premises. One is the digitization of the emerging market consumer. Second is the evolution of fintech within the emerging market financial system. And the third is wellness being embraced by most of the emerging market consumers. And those are the 5 themes where we think there is a secular opportunity for investors to allocate capital over the medium and long term.
Interesting. I want to key in a little bit on this sort of sector notion that you have, where a lot of these sort of priorities and performance dynamics will be determined by what the consumer does and what the government does, because I think it has some pretty severe sector implications.
Sure.
And intriguingly, when we look at the charts for emerging markets relative to developed markets, we find that there are 3 massive sector divergences that have developed, all of which seem to be addressed by your themes. First, I really want to key in on this industrials idea. It's one of the biggest gaps that we've noticed over the last 10 years is developed market industrials just continue significantly outperforming emerging market industrials, which have pretty much gone nowhere really since 2010. Tell us a little bit more about this industrials renaissance. I mean, industrials market cap as a share of emerging markets has basically dwindled to almost nothing. It seems like if there is a major shift in industrials, it could really change the fates of emerging markets.
Yeah, no, that's a great point. Emerging market industrials have definitely gone somewhere. They have really shrunk. So they used to be 7.5% of the market cap 10 years ago, or right around the time when I started my career in emerging markets, and it's about 5% now. And there are many reasons. I mean, think of emerging market industrial sector, the companies like ZTO Express and Anhoi Conch and L&T in India, and all of these companies come to mind. But let me really hone in on a couple of big things happening here. The first thing is that most of the emerging market governments are going to be focused on priming their fiscal pump with a very clear focus on domestic job creation, on thinking about domestic infrastructure build champions focused on creating infrastructure at the lowest end of the urban pyramid. So think about the urban poor and the rural infrastructure. With all of this in mind, there are going to be some companies that are going to be winners, and I think that are going to have secular tailwinds. Think of Larsen & Toubro in India that does some very big infrastructure projects focused on these areas. Think of Enka and Saat in Turkey that does exactly the same thing, and a smattering of emerging market companies that do that within the industrial sector. So that's one area of secular growth within the industrial sector. The other area is very interesting. There have been a lot of family-owned conglomerates in emerging markets in Asia over the years that have been classified as industrial companies. Especially now with the values declining, especially around market cap, cost of capital going up, there is a relentless focus. And more importantly, actually, the 3rd or 4th generation of some of these founders coming back with Western education and other things, there is going to be a focus on deconglomeratization, especially when one thinks of the logistics and the supply chains that are kind of really coming into their own within emerging markets. I'm going to talk about supply chains when I discuss my consumption theme, but a lot of the industrial companies embed some logistics companies within them. And there could be that embarking on value creation by demergers that could happen within the industrial sector. So these are 2 themes to ride within the industrial sector, which makes me very excited and interested in this sector. And there could be a renaissance in this sector as we move forward.
Fantastic. Well, another massive sector, obviously, you highlighted is the consumer sector. Mm-hmm. Obviously, this has been sort of the story for emerging markets for decades, is you want to have some exposure to this potential for extraordinary growth and changing consumer over time. One of the things we've noticed is those expectations have diminished significantly. So if you look at the forward forecast for emerging market consumer sales growth, for instance, it's continuously declined over the last several years relative to developed market sales growth. Yet we also see some stabilization in margins. How do you see these themes of digitization, also of wellness, sort of working through the consumer chain to really change the prospects for EM consumer companies over time?
Now, Gina, as you rightly said, consumption has been at the center of the emerging market story. It's always been about the consumer sector, about more consumption, more people entering the middle class, more people using a toothpaste and whatnot. And that kind of basic focus on investing in emerging markets has worked for a long time. But I think there are a lot of structural changes happening here. First, let me address the chart. As the chart very beautifully shows, there is clearly very low expectation built in terms of sales growth. But as you can see, margins have kind of bottomed and are kind of improving a little bit. So all of that is pointing to some operating leverage entering into the consumer sector. And a lot of that, in my view, is being driven by digitization. As you can appreciate, the emerging markets consumer discretionary sector, for example, is roughly 70% internet. Alibaba is 43% of that. So China has been way ahead of the pack in terms of the digitization of the consumer. And what I mean by this digitization of the consumer, clearly in China, you have a lot of the consumption driven by these digital platforms, which essentially opens up this operating leverage gap. But this is being now followed in many other markets too. So think about Mercado Libre in Latin America, think about Yandex in Russia. But more interestingly, talking of this deconglomeratization theme within consumption as well, take the example of Reliance, which was a petrochemicals company in India, but they essentially have given birth to we are hopefully at demerger in the coming days to the Geo platform, where Facebook has been a partner and a lot of capital has been raised. So there is this opportunity set that's getting created within other emerging markets where the digitization of the consumption trend is here to stay. And what that's going to do is it's going to change the valuations of the sector. So the old traditional consumption companies would give way to these digital platforms, taking share from them. But there are a couple of other things within consumption as well. When you think of the upper end, the upper echelons of the emerging market consumer, there's going to be much more focus, especially post-COVID, on healthcare, wellness, and themes as such. If you look at the healthcare sector, it's roughly 4% in emerging markets, but roughly 15% in the S&P, give or take. Now, the biggest thing that's absent within the emerging market healthcare index is healthcare service delivery. So there are hardly any medical equipment companies that are listed or of any consequence, or hospital or other delivery mechanisms. We think that that's going to change a little bit. And that, again, is going to come from either the native small cap ecosystem or the mergers from some of the larger family-owned companies. And those are like the two trends. So that's one trend is at the upper end of the spectrum, you see wellness. But at the lower end of the spectrum, especially as more stimulus money goes to the urban poor and the rural consumer, there's going to be a focus on some of the consumer staple companies with large bandwidth of products, a good recall brand names and others who have the scale and the efficiency to serve this lower end of the consumption sector. So think of companies like Hindustan Unilever or Migros in Turkey and a few other companies as such. So Mexico, Brazil, India, Turkey would be markets where there could be very significant stock picking opportunities at that end of the spectrum.
Great, thank you. Now, I've been with you on all four of these themes so far, but this last one, I have to say, I think it's the elephant in the room, and I want to talk a little bit more about financials. It's pretty clear that financials globally have been in a sort of a secular discount sort of state. Right. Valuations globally are very cheap, but emerging markets are particularly exposed to financials. Obviously, you've got to have somebody funding all of these themes, right? And emerging markets have a tremendous amount of non-performing assets issues, as well as inefficiencies, high cost structures. But you see the prospects for fintech really changing that. Maybe talk us through this.
Sure. So the financials is clearly the elephant in the room. There's no doubt about that. The financial sector is 21% of the emerging markets index, is roughly 11% of the S&P. 69% of the 21% is banks. These are, think of large banks, China Construction Bank, HDFC Bank, Itaú, Bradesco, and things as such. So clearly, and as you correctly pointed out, they do have issues. They have NPA issues, they have bloated cost structures, they have last mile delivery issues, and efficiency issues around kind of looking at the next stage of growth, which is almost always going to be lower ticket, lower end of the consumer, urban poor, and rural, especially with all the fiscal pump priming. So clearly there are issues that they need to solve. But my view is that the fintech evolution is going to help them on all these counts. Think about credit decisioning or NPAs that have been created. Think of more big data, analytics and other things that's going to help credit decisioning and make it a little more analytical, especially as small and micro businesses are evolving into, creating their own digital footprints, and consumers are creating their own digital footprints within emerging markets, but also when it comes to the cost of delivery. So I think what's going to happen is within the banking system, you're going to have, some companies, think of the HDFCs and Kotak Mahindras and the ICICI in India, Bradesco in Brazil, China Construction Bank and Ant Financial and others in China. China is a little bit more internet driven into banks, but most of the places it's going to be the large incumbent banks, Sberbank in Russia. These incumbents are really going to harness this fintech ecosystem either within their franchises or via acquisitions to reduce that last mile cost of delivery, to improve their credit performance. So if you ask me a question, is this elephant going to remain an elephant? I absolutely think so, because financials are an important transmission mechanism in growth markets. Having said that, it's going to be much more of a nimble and digitized elephant, if you may.
Perfect. Thank you for those. Thank you for sharing your thoughts on the outlook for EM, as well as the 5 themes that are likely to drive EM equities over the next 5 years. And thank you to our audience for joining us. If we can help with anything, Gaurav and I are both available on your Bloomberg terminal at any time. You can also access our research at BI_STOXGO on your Bloomberg.
Thanks, Gina. And thank you, everyone.
All right. Our thanks to Gina and Gaurav there, of course, for that interesting conversation. We're going to move this more to another poll question right now for everyone in the audience here today. The last one for the day. What's next for the U.S.-China trade? A, phase 1 of the trade deal, it will move ahead. For B, the parameters of this trade deal will be changed and agreed, or the U.S. will pull out of this trade deal, or China will pull out of this trade deal. Let me see what your responses are. All right, so far, I'm seeing 45% say the parameters of the trade deal will be changed and agreed. Obviously, there's been a lot of questions about whether China can live up to some of these commitments they made in terms of ag purchases and whatnot. What we're seeing so far, it looks like most people, at least more than half, think that perhaps they're going to have to tweak a little bit of the agreement here. 25% say it's going to move ahead. 16% say the U.S. will pull out of this deal, and only 5% so far say China will pull out of this trade deal. So at this point, it seems that people are still a little bit optimistic about where this phase 1 trade deal is going to be after this, on the back of that meeting that U.S. and China had in Hawaii as well. All right. I think it's time for our third session right now. We got a great panel that's up ahead here, and great voices from the PE side as well as the asset management side. I'm pleased to bring in Sheila Patel, chairwoman of Goldman Sachs Asset Management, and Jean-Eric Solana from Barings Private Equity Asia, the chief executive and founding partner. Sheila Patel, I was going to just kick off with your bios real quick. She has leveraged her knowledge of portfolio solutions, sustainable finance, emerging growth themes, governance, and other key long-term trends to advise clients. She also oversees Goldman's asset management, ESG, and impact investment initiatives. She joined Goldman Sachs in 2003 as a managing director and was named partner in 2006. Jean, from Barings, was responsible for the investment activity of the firm since 1997, when he started the regional Asian private equity investment program for UK-based Baring Private Equity Partners. He later led the management buyout of that program in 2000 and established Baring Asia as an independent firm. So thank you so much for joining us, Sheila and Jean. Thank you. And let's kick it off here, because we were talking about a survey just now that we were asking the audience about where we are in this economic recovery. It's obviously been a tough couple of months. The situation is still very fluid. There's fears of a second wave as a lot of these economies do emerge out of this crisis. Where are we now? Sheila, I'll bring the first question to you.
Thanks. Well, it's great to be here. And look, I think we are in the middle of the game, nowhere near the end of the game in terms of this crisis. I think people have looked for V-shaped recoveries, and what we see is a series of recoveries, smaller Vs by sector, by region, a lot of concern, as you mentioned, about second waves. So we have a long way to go before we're on solid footing, and I think you'll see market volatility due to that.
And John, tell us what's going on inside your portfolio companies right now in Asia. Which industries are faring better? Which are you think can actually excel in the future coming out of this crisis?
Yeah, thanks, Yvonne. Thanks for having me. Well, it's been a very brutal dislocation that we've been through in the last few months, and it's affected just about every company in every sector. But we are starting to see some signs of recovery in some sectors and in some markets. I think China was the first to go into the crisis and is the first that we see coming out of the crisis. Many of our companies that we've invested in China are already operating at nearly full utilization, in some cases up 5 or 10% year on year. I think we're all cautious about what's going to happen when the impact of the declining demand in Europe and external demand in the US hits the export sector of the Chinese economy. But we are starting to see some positive signs of a bottoming, at least in other markets as well, and the beginnings of recovery. I think we're sort of managing our portfolio on a week-to-week, month-to-month basis, working with our companies, keeping the communications line open, and making sure that we're responding to changes in the market conditions as quickly as we can. But there have been some changes and some effects from the crisis that I think will be long-lasting and permanent, some negative and some positive. On the positive side, what a crisis like this enables you to do is to really use the crisis as a catalyst for making some of the tough decisions that were more difficult to make in an organization during normal times. So some of the structural changes, the cost changes, even the business model changes that we're seeing may be beneficial in the long term and may be permanent as a result of this crisis that we've had to live through. So overall, yeah, go ahead.
Yeah, we'll get to some more examples a little bit later. There's a lot of questions streaming through here now, Sheila, on just what's going on in the markets right now, right? We've seen this tremendous rally since March. Central banks, as one viewer asking, have they actually created a floor for asset prices? Is there now no argument for bearish positions?
I don't think they'd say there's no argument for bearish positions, but certainly central banks around the world have showed a willingness to stop any declines and to be supportive in this difficult environment well beyond what we saw in the financial crisis, and they continue to step in. So I think, the question remains as to is there an endpoint, and most importantly, how do they roll back some of this support? But I also think that there are investors interested in important opportunities. For example, I had many global investors say the central banks almost were too quick on the credit front, and it shut them out of potentially some opportunities. Now, I think there'll be plenty ahead, and there's plenty of challenge that will create these chances. But we saw both large institutions and of late retail very supportive in the markets. So the buyers are there and they see long-term value.
So Sheila, do you think the retail investors, they're here to stay?
The retail investors have been something we've been watching extremely closely. They were not nearly, as strong earlier in the crisis. But if you look at mutual fund data, and particularly you look at ETF flow data, it's been quite notable to see the amount of retail interest, particularly in the U.S. I think it's also been interesting to see some of the trends within that data. For example, as we talked, as you were mentioning in an earlier discussion, there are a lot of things that have changed in the mindset and that have changed generationally. ESG might have been thought as a millennial theme. Boomers are actually some of the biggest consumers of ESG ETFs right now. So I think retail is here. I think that it should be reasonable to expect some skittishness because that's always how retail is. But it seems like solid footing.
And Jean, what are your GPs focusing their energy on the most now? On a spectrum of portfolio bailouts or sitting on the sidelines, or is it time to actually seek new deals? Where do you sit right now?
Well, I think a lot of the heavy lifting on the portfolio side has happened already, and people are more focused on new opportunities right now, assuming that things don't get worse from here on the portfolio side. There's certain sectors that are benefiting and that are safer to invest in, areas like IT and anything to do with digital and e-commerce, logistics, healthcare, education. These are some of the broad themes that we're looking at and others are looking at. But I think broadly speaking, some of the kind of tactical opportunities in private equity right now are going to be around dislocation, say, in the public markets, where you may see a few take privates happening or deals in the public markets that involve structured type transactions where private equity firms step in to help recapitalize, say, banks, or help recapitalize the balance sheets of companies that are looking to raise capital in this kind of an environment where there's more uncertainty.
And John, you mentioned a little bit about some of your portfolio companies, and maybe provides us some examples of how they're actually excelling right now and adapting to not just a post-COVID world, but what they're seeing right now in the middle of this crisis.
Yeah, it's interesting. I think, for example, we have some companies. We have a company in China that does cosmetics packaging, and they're a global business. About 90% of their business, I would say, is historically been in the U.S. and in Europe, and exporting to some of the larger cosmetic companies around the world, like L'Oreal, et cetera. And what's happened is, as China has reopened, the manufacturing operations are up to full capacity and operating at normal levels. But the overseas demand has fallen off in Europe and the US because of the delayed lockdown impact there. Instead, we're seeing a big pickup in domestic demand in, say, the cosmetic sector in China. So at the moment, about 40% of our revenue is coming from domestic cosmetic companies in China, whereas previously that was only maybe 10% of our business. And overall, if you add it up, where, as I said earlier, about up maybe 5-10% year on year on a combined basis, sort of pivoting the business to be more focused on where the demand is starting to emerge, which is really in Asia at the moment versus the US and Europe.
And do you think that some of these changes you've seen, to what extent are they fixed? Are these permanent things that could stay?
Well, some of them will be permanent. For example, the acceptance of digitalization and just the whole remote working and remote purchasing patterns that we're starting to see. We have a company that's involved in testing, delivering tests like the SAT test or the CFA test. And historically, those tests were done in testing centers for security reasons and just generally out of sort of custom. But we've been trying to institute a remote testing program for years, and we've had a lot of resistance from customers. Now, in the midst of this, customers are really, really asking for it. And so we have been able to accelerate the rollout of that remote testing technology. And now about 40% of our business is being done remotely, which in the long run will help us to scale the business, improve our margins, and provide a better service to customers. And I think that will probably be a permanent change that we'll see to that business through the customer acceptance, sort of the acceleration of customer acceptance of doing more business, more transactions remotely than was previously the case.
Sheila, we have a viewer question now. Are we in a giant asset bubble or on bubbles in certain sectors? Is e-commerce going to pop once shutdowns finish? What's your take on the side of bubbles right now?
Look, I think it's too early to call what's going on in any sense, a bubble. Obviously, people get concerned about that, particularly when you see the levels of government support, of central bank support. And as we look at it, we're much more focused on the long term. At the end, governments, to resolve this crisis, to help, have taken on tremendous amounts of debt. When you think about that, there's sort of two ways to handle that. You pay the interest or you inflate your way out of it over the long term. And I think inflation is raising its head on people's radar from the long term, again, a several year perspective, and we see investors preparing for that. A little inflation is not necessarily a bad thing. It may take some time with unemployment levels where they are. But I think some of the themes or the challenges in resolving what's been done to aid during the crisis and then unwinding it is maybe what are the tides ahead that have to be looked out for more than a bubble per se.
Mm-hmm.
And John, you mentioned a little bit.
I've got a couple of thoughts on the point, the valuation question, because it's something that's also an issue for us as we look around and look at prices where they are today. It's interesting because in a way the markets are being very rational. Normally, I would argue they're not always very rational, but in this case they seem to be kind of rational because instead of the knee-jerk reaction of earnings are going to decline, therefore stock prices should go down. I think that was more of a concern when people were worried about solvency and liquidity and whether we were really heading into some sort of a depression. But when that was taken off the table through the Fed action, then people started acting a bit more rationally, which is to say that the value of a business is really the net present value, the discounted value of the cash flows going into the future. And you could argue that what happens over the next 6 to 12 months does not really affect the long-term value of any business. And then the next part of that equation should be, what is the discount rate? What is the interest rate that you're using to discount those future cash flows? And given the steps that have been taken by the central banks and also the likelihood of those interest rates staying down for maybe another 1 to 2 years or more, then the discount rate that you would be applying today would be much, much lower, which is another way of saying that if you want to make any kind of a return on your money, the only place to put your money these days is into this equity markets or markets that have more equity value associated with them, as opposed to fixed income or cash or anything like that. So in some sense, it's really driven by where interest rates are and the fact that interest rates are so low and are likely to stay very low for a long time.
And of course, both of you guys were talking a little bit more about the recovery in China as well. I'm just wondering, Sheila, has the COVID in any way delayed your expansion plans in China?
It really hasn't. I mean, obviously, we're working toward, and we had.
Okay, I think we're having some technical issues with Sheila right now. We'll try to establish her audio. Jean, I'll swing it back to you on the recovery in China. We've seen when it comes to PE investments involving foreign players, foreign investors, that's pretty much cut in half in China right now, according to some reports that I've seen. Are foreign investors still quite cautious about investing in China? What's your take?
Well, I think China, from a macro standpoint, the economy is coming out of this first globally, and China is likely to be responsible for more than half of global growth going forward. So there's certainly a lot of interest globally in investing in China. I think what you saw in the run-up to this was a bit of a bubble in the whole technology sector and the venture sector, where company valuations got elevated. And I think now there's been a reality check. And that was not just driven by COVID-19. I think there was also some global reality checks and things like WeWork and other companies like that, where people took a step back and said, wait a second, these companies are not making money and they're unlikely to ever make money. How should we be thinking about valuations? So there's been a few factors at play in the early stage technology type of investing in the market. But I would say that overall investor interest and private equity interest and venture capital interest in China remains high. The amount of digital transformation that's going on in the economy is pretty impressive. In fact, you could argue that the entire economy really should be thought of as a digital economy. And by and large, the division that people used to make between old economy and new economy, a lot of that is starting to blur because it's really embedded in just about every aspect of the economy now. So most businesses that we look at today, and we're more of a private equity investor, less of a venture investor, anything we look at today, we need to understand how technology disruption is affecting that business and also what the opportunities are with technology in that business in China specifically.
All right, I think we got the technology issues resolved with Sheila. Sheila, you were saying expansion plans in China.
Yeah, look, I think this alone shows you we have a long way to go on our tech, but we're all getting better. I think from our perspective, China is a long-term play for us, and we're not changing our plans. We've been engaged in our JV there and continue to look to own that in full for every part of the firm, so not just asset management. I think the U.S. and China relationship notwithstanding, both places are huge opportunities from a business perspective, and we'll continue to pursue that.
There's been a report out there saying, Sheila, that Goldman has been in talks with Chinese partners, including ICBC, in some type of JV on the wealth management services business. What can you tell us at this point? Well,
that might be a purposeful technical default on her part. Maybe she doesn't want to.
You lose. How convenient. All right.
That was a convenient one, Sheila.
On with that.
Oh, wait, got her back. Okay, Sheila, continue. Sorry about that.
Yeah, all I'll be saying is we're always in talks with a number of potential partners in every country. I think China for us is a big opportunity. We don't have anything new to announce yet, but you are reasonable to expect that we'll continue working with a number of partners.
How do you differentiate yourself, though, Sheila? I mean, there's a lot of global asset managers that are just rushing to expand in China. So far, you've kind of focused funds on A shares, bonds, not really generating a whole lot of returns. I guess in general, it's not that exciting, I guess. How do you differentiate yourself in China?
Well, look, I think, one key thing that's different and that I expect will be very important in the years ahead is we're an active manager. And, I agree with what was said earlier that we're in a period where it's tough in fixed income. It's tough to be an index type player when you have such transformative changes going on in global economies. And I believe, being in active right now, when we're about to, I think, go through a renaissance of active, whether it's public equities, private equities, et cetera, is going to be essential and a real value add for our clients, because this is not an environment where just indexing works, frankly. You need to actively figure out what technologies and innovations in industries will be the ones of the future.
And this is a question for both of you guys.
Your point there about being more bottom up, and that the days of market beta lifting all boats. It's going to be a little harder, I think, going forward. At least immediately post COVID, there's going to be a lot more granularity required in where you invest and how you invest, and being an active investor, whether it's on the public equity side, certainly in private equity, the model of being an active owner of assets and really driving value creation, I think will start to be more and more differentiated as public markets go through a period of adjusting to the new realities.
What about for both of you guys when it comes to headcount? Jean, are you hiring right now?
We continue to hire. We've not shrunk in our business. We've not had anybody not let anyone go. We are continuing to grow our business each year. We're not a huge organization, but we continue to add people into our business every year, and we plan to continue to do that.
And Sheila, can you give us maybe specific targets for headcount, particularly in China? How does it stack up against Hong Kong and Singapore, for example?
Look, I think at the moment, so we're still hiring, but I don't expect our footprint in the very short term, as in the next 3 to 6 months, to change very much. Actually, one of the biggest things is just given the way our culture works and the strength of our culture, it's very hard to hire people via Zoom. And so for a lot of our, key opportunities as we think about things, we really want to meet people, bring them in our offices, have them know us, not just in a local office, but have them get to London, New York, et cetera, and really know entire teams, because we run global teams. So we continue to hire selectively when we have processes already in place. But for some of the newer things we might do, particularly in the Asia region, I think you may see it wait a little bit for a bit more of the recovery to ensue.
And of course, we mentioned a little bit about China. We can't forget about Hong Kong as well. We've seen the U.S.-China relationship being roiled by the Hong Kong situation right now. It's looking a little bit more cloudy. We just got a little bit more detail on this national security legislation. Sheila, just given what you're seeing politically here in the city, how is Goldman planning their resource allocation near term?
Look, I think we watch it with a fair bit of caution. It's been very challenging for our teams, and we're most focused on our people. It's been protests, then COVID, then protests again as people try to return to the workforce and return to the office. And I think nowhere have we seen more interest in getting back into the offices than Hong Kong, where people appreciate the resources as well as the collegiality and camaraderie of the office. So we've been trying to work with them on really safe ways to get back. I think from a markets perspective, we and the clients we work with have been very concerned about the disruption and particularly kind of the geopolitical situation that exists with the U.S.'s region to some of the goings on in Hong Kong.
And John, you talked a little bit more about having a pretty positive outlook on Hong Kong. We've just had these secondary listings, these Chinese companies returning and listing here in Hong Kong. We talked about China easing rules on listings with Charles Lee as well earlier. Is this a good or bad thing? And what does that tell us about globalization now?
I think Hong Kong's role as an international financial center is going to go from strength to strength. I think the importance of Hong Kong as a capital raising center and a financial center, particularly for China, is only going to increase given the current geopolitical outlook that we see in the U.S. And you're seeing already companies delist from the U.S. or have secondary listings here, like JD.com, like NetEase, and others that are planning to do the same. So I think that will continue. I think Hong Kong is likely to become much more integrated into southern China with the Greater Bay Area project, which I think will create another impetus of sort of energy and growth for Hong Kong. So I remain positive on Hong Kong. We're headquartered here, and we have every plan to continue to grow here and remain here.
And when we talk about exits, how are you seeing it right now? Do you expect any of your portfolio companies to exit in the next 12 months?
The exit environment is difficult at the moment. Now, having said that, we've just had, in the last few months, we've had 3 exits of companies that were already listed, and we took the opportunity of markets being as buoyant as they have been to take some money off the table. But I think if you're talking about sort of a strategic sale at the moment, particularly a sale to another financial sponsor, one of the limitations is that most sponsor transactions are going to involve debt, financing, or leverage in the transaction. And the debt markets, while they've come back for investment grade credits, I think the overall sort of sponsor type financing is just starting to emerge. So I would say that most companies that people were intending to sell pre-COVID, people probably want to wait to demonstrate the next 6 to 9 months as being solid earnings period to then sell off those numbers together with a stronger financing market rather than sell into weakness right now. So I would expect the exit market to be a little bit subdued over the coming months.
And Sheila, Jean mentioned about the Greater Bay Area. There's been this whole excitement over this Wealth Connect plan, and the Hong Kong Funds Association, they're proposing that residents in the area can take part in some of these authorized funds in Hong Kong. What have you heard so far about this development? Does that shout opportunities for Goldman?
Look, we're very excited about it as well. And I think just in general, making funds easier to use for investors, particularly in the Greater Bay Area, where customers really haven't had as many options and where the fund landscape has been more complicated, we're very much in favor of that. I think that, it always takes time to figure out whether a regime will actually be as easy to use as it sounds. So that's still a little bit to be seen. But overall, definitely a positive development and something we need in the region.
All right. I want to end on this one viewer question, which I thought was quite interesting. We do this quite a lot, too. For the retail investors watching, I'm going to ask both you guys. If you have $10,000, where should you put it right now? John, I'll let you get the first word.
$10,000, huh? I would say, I would probably, being an Asian-focused investor, I would say that Asian markets at the moment are relatively undervalued, particularly, say, Hong Kong market and the China market are relatively undervalued compared to, say, the S&P 500. So I would focus on this part of the world as being better value at the moment.
Sheila, last word for you.
Well, as usual, $10,000, same question mark. Depends a bit on where the rest of your money is, if you have it, and what your time frame is and your age. But I would say, it's a time to look at the long-term opportunity set in the equity markets. I think fixed income is extremely difficult. I think with that amount of money, a diversified set of equity fund holdings probably makes the most sense if it's an incremental investment.
All right, Sheila, Jean, thank you so much for joining us. It was a great discussion. Apologies for the technical issues, but you guys were rock stars. Our thanks to you guys. Thank you. All right, we're going to final guest of the afternoon here before we wrap things up. Hee-Nam Choi. This is the Chief Executive Officer of South Korea's Sovereign Wealth Fund, KIC. He's been there since March of 2018. He was also the chairman of the board. Prior to that, he was also part of the IMF, the executive director for the Republic of Korea, and representing 16 countries in the APAC region. He spoke with my colleague Heidi Luen on how he's navigating these dislocated markets right now. Let's take a listen.
Right now, so as you see, given this volatile and uncertain financial environments, KIC is taking a balanced asset allocation approach. But the equity market and bond fixed income market, both markets are quite, looks good given such a external shock. But considering our mandate as a long-term investor to achieve the kind of stable risk-adjusted returns, we try to, our best to achieve long-term returns. But at this stage, let me introduce a few our tech examples to try to the stable returns. At the end of March, we tactically overweight equities through our asset rebalancing. And also gradually, we are increasing our allocation to alternative investment, which make up 16% of our total asset.
Right, so where do you find opportunity? Because when you're a long-term investor, you would be looking at value, right? Whereas basically the market has been rallying, still not really going through to this rotation from growth to value.
But still we believe that given the high equity valuation, we think there might be some limit for the market rally. So it might be better to prepare another market dislocation for the time being. So we are more cautious at this stage, but in the long run, we strongly believe that the market will fully recover, but for the time being, we might take a wait and see position for our asset allocation.
What do you think the next downturn or the next uptick in this market will be driven by?
Obviously, most market participants expect that maybe the second wave of if we can prevent, we can fully overcome the second wave of coronavirus, which helped by the vaccines or treatment. Then we might, prevent the second market further forward. But I believe that due to the central bank and government strong, policy backstop, we can rally further. But to be frank with you, we have no idea when it is the right time for the market rally. But at this stage, we are very happy about the current market situation.
What about geographically? Do you have any preferences over, for example, a lot of investors expect a quicker recovery in Asia?
Obviously, the shock from the COVID-19 came to the Asia first. So if you look at Chinese market, China is the first runner in overcoming the shocks from COVID. So I'm pretty sure the Chinese market, we can see the huge potential. And next, I think the US obviously now experiencing the market turbulence, but the financial markets looks quite good. But in terms of real economy, we might expect further deterioration in the market indicators. But anyway, we can see the next market destination might be the US market.
Have you made major changes to your investing strategy or to your portfolio since the start of the pandemic?
As I mentioned before, yes, we slightly, overweight equities compared to the fixed income. That is our first strategy. But if there is a second wave, we obviously reconsider our asset allocation. But if there is another market shock, we might slightly, maybe further rebalancing our asset allocation toward equities, because you might see further potential in the equity markets.
Have you thought about the post-pandemic changes? So, for example, we've spoken about changes in consumer behavior, changes in workplace, what the post-pandemic workplace might look like, what working culture might be. So are there investing ideas around these more permanent changes that you could expect to see that you're thinking about?
Yeah, of course. Yeah. I strongly believe that the COVID-19 has brought a paradigm shift to the investment horizon. So accordingly, we will be looking at investment related to digital infrastructure and ESG, supply chain, and also healthcare. I think these are all areas that play a big part in how our lives will change. First of all, we are living in a contact-free economy where life has become virtual. So we need proper digital infrastructure, and we'll focus more on this. Second, we'll also pay more attention to ESG and place more stress on the S social factors. Third, as for the supply chain, it looks like we will be living in a less global world, the deglobalization. So companies will want to secure domestic or regional suppliers. We will look for beneficiary of this change in the supply chain. Lastly, healthcare. We live in already an aging society, and obviously we just went through a pandemic. We have also seen how the global healthcare system needs to improve. So going forward, we will care more about various parts of the healthcare industry, especially biotech.
So is it fair to say a more streamlined supply chain, tech as well as healthcare would be the three investing themes that are important to KIC?
Yes.
How does that get threatened by geopolitical tensions, with the China-US war being so focused on tech, on 5G, on AI? Is there a concern that with the reignition of these tensions, we had President Trump just saying that a complete economic decoupling is still possible between China and the US? Does that threaten the entire tech sector?
Yes, obviously, the US-China is, they are trying to, kind of grab the hegemony of the tech industry. So it looks like before the tension of the two countries, the global world working very well in terms of the tech development. But China wants to set up their own technology world. On the other hand, US also try to build their own technology world. So as a global investors, we might need to take a right balance, but I still believe that the political tensions and military tensions, it might happen. It might be, just a one-time event rather than the permanent global trend. I know after a US presidential election, then I think we might look for, kind of a more cooperative global world rather than, de-globalized kind of competitive, world. So in some sense, I'm very, that current issue, the political tension might be the short-term trend rather than a long-term trend.
How do you assess the Korean government's handling of the pandemic there? Clearly, it was caught early, a lot of testing was done. And is that management enough to get the economy back on track, particularly relevant to what we were just talking about? Korea is so vulnerable as a bellwether to both global trade and that deglobalization story.
Yes, Korean government, at the initial stage, we took a kind of, very proactive government, government actions like we call it 4Ts, like the treatment, testing, tracing, and also transparency that actually help us. We avoid lockdown of Korean economy. So, compared to other OECD advanced G7 countries, our economic growth forecast this year, it depends on the research institute from 0% to minus 1.5% kind of thing. But our economic growth forecast looks better than other G20 or G7 countries. So this kind of proactive measures by government on COVID actually help us manage the Korean economy manage better than compared to other countries.
Do you stay away from, for example, for now, Hong Kong listed stocks or China listed stocks because of the ongoing national security law concerns there?
Hong Kong, Hong Kong is, it's very difficult to say, but I think the Hong Kong, I believe the Hong Kong can manage to the current economic difficulties by, working together. In some sense, I'm very political sensitivity issues. Yeah.
So as you mentioned earlier, you'd also been looking at alternative investments, infrastructure, real estate, and obviously with traditional markets where they are at the moment, it's perhaps more appealing to look to alternatives as a hedge. Has that been difficult in the COVID era, given that you can't really, in a traditional way, do due diligence, for example, if you're looking at infrastructure investments?
Yes, actually, to increase our alternative investment, which is real assets, the due diligence is kind of an important part of our investment process. But because of COVID-19, and thanks to the advancements in virtual technology, we have upgraded this process. So we have amended our guidelines to allow virtual due diligence for some investments. And we even found a few benefits of doing this. For example, for on-site due diligence, we need 2 or 3 people to actually go there. But virtually, more people, maybe many related departments can join the process. But on the other hand, I think there are limits though for things like direct investment in real estate. We need to be there. So still, on-site due diligence plays very important role in terms of the real investment.
So when you took on the chairman role in 2018, you had said it's your ambition to get assets under management to $200 billion US. Can I ask where you are at with that goal? What's sort of preventing you from getting that number, and do you anticipate in meeting it anytime soon?
Yep. we believe that we can achieve the target by 2023 or 24. But at this stage, it's very difficult situation to increase our asset, given such because KIC is managing our foreign reserves. Given such increase of foreign reserve is very, there is a kind of limitation. So it's difficult to increase our asset rapidly. So we are looking at other ways to, to get some money from other Korean LPs, like the pensions or some credit unions kind of thing. So that is the way to increase our clients, to have more, to increase our assets. But, at this stage, we have to work harder to invite other LPs to join KIC.
I want to ask you more about your ESG investment strategy. That's mostly been equities focused. Would you be looking more at bonds as well as we're seeing more and more issuance of COVID response bonds? Would that be a consideration?
Yes, of course. At this stage, we invest in ESG bonds. They account around $1 billion of our portfolio. Since COVID-19, we have been monitoring the issuance of related bonds, COVID bonds or pandemic bonds. These issuance, we know that have doubled over the past year. And I'm not surprised because they help us to achieve long-term returns. At KIC, we are focused on not only including ESG bonds in our portfolio, but also on actively participating in ESG bond market. As you know, KIC is a sovereign wealth fund of Korea. We invest in our future. So naturally, we promote sustainability. ESG bonds help us do this. Last year, we took part in issuance process for Korean government's $500 billion green and sustainability bond. We helped make the framework for this, outline eligible investment assets and more. So we aim to play more active role in global ESG market. We also just put out our sustainability investment report. So if you are interested, you can find more details on KIC website. about COVID and pandemic bonds, applying the same standards we use for ESG bonds, we would be happy to invest in these bonds as well and return profile.
Mr. Choi, with the Black Lives Matter movement in the US, increasingly we're seeing listed companies come under scrutiny for lack of representation and lack of diversity. I'm wondering, is that an element that you consider to be a priority when you're choosing to invest?
Yes, like among the three factors, environment, social, and governance factors. Up to now, we much focused on the E factors, but we, try to increase our focus on G factors, also S factors. So, like the diversity is very important in terms of governance, also in terms of social factors. So, definitely, we try to work hard to, highlight the importance of the governance factor, also social factor.
All right, and that was Hinam Choi there from the Korean Investment Corp speaking with my colleague Heidi Stroud-Watts earlier. That concludes our first day here for Invest Global. We want to thank everyone for kicking things off for us here out of Asia. We hope you enjoyed the discussions, and we really want your feedback as well. So there's going to be an exit survey as you leave the virtual conference here today. That's going to appear at the screen towards the end. Please take some time, fill that out. Let us know what you thought of everything. We want to thank again our speakers and, of course, our sponsors as well. Our U.S. founding sponsor, Investco QQQ, our European sponsor, CMC Markets, and EcoBank, our Middle East and Africa sponsor. So this is just the beginning. Stay tuned for all the day one sessions that are going to be happening in the Middle East coming up next, and then London, as well as then New York and concluding there. Each event's going to start at 1 p.m. local time. So make sure to check that out. Tomorrow at 1 p.m. here in Asia, my colleague Haslinda Ahmed is going to be taking over and hosting for day 2 of the Invest Global series. So thanks again for joining us. You can follow us on Twitter at Bloomberg Live and on LinkedIn for some updates as well. If you want to follow, of course, the ongoing coverage, markets coverage of finance news, make sure to check out at Business and on Bloomberg.com. And if you haven't considered yet, please do consider subscribing and getting a subscription on Bloomberg.com. You can find that on Bloomberg.com/subscriptions. Thank you again and have a great week.